Welcome to the monthly roundup from Kepler Trust Intelligence, where Ryan, David and I will be covering all the news in the investment trust world over the month of February. And once again, there's certainly been a lot going on. So Ryan, could you take us through some of the most interesting stories from the last month?
Yes, of course, Jo. So once again, we start with the news of the activist investor Saba Capital, headed up by Bose Weinstein. As a reminder, in last month's podcast, we discussed his attempts to requisition 7 investment trusts with a range of different goals and outcomes for those. Now, as a Brighton fan, I really don't want to revisit 7-0 scorelines, but these votes have all been done and the measures were rejected in each case. It's worth noting that in a couple of these trusts, so Hot and Keystone, they were planning to wind up anyway, and therefore that process is now continuing for these trusts. Saba, which continues to hold large stakes in these trusts, as well as several others, has now launched its second tilt at instigating action, proposing to turn 4 investment trusts into open-ended vehicles. The current targets are Schroder UK Midcap, European Smaller Companies, CQS Natural Resources, Income, and Middlefield Canadian Income. 2 of these were targets under the first campaign.
So what's the play here?
Well, we believe this new strategy has a bit more logic behind it. By converting the trust to OICs, shareholders will in essence benefit from the discount narrowing and giving opportunity to those allegedly stuck in discounted trusts a route out. However, we think this arguably misses the point as to why investors hold investment trusts. There are many benefits of the trust structure over an OIC structure, such as the fixed pool of capital, an ability to take more conviction in holdings, and for the managers to use gearing, which investors would likely have been aware of when they invested in an investment trust, just as they would be for the potential for trusts to trade at a premium or discount to NAV.
And do you see any positives from Saba's campaign?
Well, what this is doing is not only shining a light on the investment trust sector, so giving it more publicity, but also focusing the minds of boards, sparking them into action. We've seen a flurry of corporate actions, from share buybacks to changes in dividend policies, to help try and narrow discounts and please shareholders, which is encouraging. Either way, the saga rumbles on, and there are several more trusts that Bose has not yet taken any action on. We have seen the announcement of some remedial action from a couple of trusts in the last few days, so we will no doubt be discussing this again in the not too distant future.
And sticking with the activism theme, we saw the launch of a new investment company recently. Can you talk us through that, Ryan?
Yeah, of course, David. February saw the quite curious launch of Achilles Investment Company. This kind of snuck out with very little fanfare at just a £50 million market cap, but it is run by Christopher Mills of the Harwood Group, which include other investment trusts in their stable like Rockwood, and he's joined by Robert Naylor, former chairman of the likes of Music Royalties Trust, Hypnosis, amongst others. The goal here is to use the capital raise to buy stakes in a number of discounted investment trusts and find a way of unlocking some value. Considering the size of the trust at present, it's not going to be quite as tumultuous as the campaign by Saba, but with 2 experts in the likes of Chris and Robert, with very strong pedigree, there is a potential for this to make some waves. Details of the targets are limited at present, but it's another sign that some industry big hitters are spying opportunities in the investment trust market, especially with current discounts persisting as they are.
And now moving on to some trust-specific news. February saw the start of the newly minted Invesco Asia Dragon. So could you talk us through this one, Ryan?
Yeah, of course. And as ever, we'll just start with a bit of background. The board of Asia Dragon, which was previously run by a team at Aberdeen, started a so-called beauty parade for suitors to take on the assets. This was sparked by a fairly audacious attempt from Ashoka Emerging Markets, despite the trust being less than a fifth of the size, to take over the assets of Asia Dragon. In the end, the board chose the Invesco Asia Trust, managed by Fiona Yang and Ian Hargreaves, to take on the mandate as a result of their track record of generating alpha in a range of market conditions. As such, the freshly minted Invesco Asia Dragon Trust, or IAD, is now the largest trust by net assets in the Asia equity income sector. However, there is some internal debate as to whether this is actually the best peer group for it, considering the manager's approach of looking for contrarian value opportunities, then having an enhanced income model that pays out about 4% per year. We are due to publish a review of the Asia equity income sector in an upcoming article, and a fresh note on Invesco Asia Dragon is likely to come out in the next few weeks. So please do add the trust to your watch list if you'd like to be the first to hear about it.
And we've seen some corporate activity within the infrastructure sector as well. What's happened there, Ryan?
Yes, a couple of quick snippets from the listed infrastructure space. Firstly, there's been a successful bid for BBGI from British Columbia Investment Management Corp for just over £1 billion. Not only was this a 21% premium to the previous closing price, but more importantly, it came at a small premium to NAV. Now, in a world where many investment trusts, especially the infrastructure ones, are trading at a discount because investors are questioning the legitimacy of those NAVs, is a really positive indicator that maybe some of those discounts are excessively wide. That being said, BBGI is one of the higher quality trusts in the sector. It also has an internal management team, which not only makes it very cost efficient, but also means it can be quite easily lifted and plugged into another organisation.
Yeah, and there is, I guess a wide range of, different qualities of kind of infrastructure trusts around. Has there been any kind of knock-on effects elsewhere in the infrastructure world?
Yeah, absolutely. There's been a little bit of movement in the discounts of some peers. They narrowed slightly off the back of the BBGI news, though we've also seen some more news out of TRIG, or the Renewables Infrastructure Group. Firstly, their fee structure was tweaked to be based on market cap rather than net assets. Now, this should provide further incentive for the managers to encourage that discount to narrow, with the sort of 35% discount it's currently trading on. Although as part of this, they did tweak the structure that they have an additional 0.5% bonus fee introduced alongside a performance fee for any portfolio disposals. Now, this may seem somewhat counterintuitive. It means it's paying the assets for shrinking the portfolio in one take, but the sums equate to around a year's worth of fees, and also has many hurdles in place, meaning the assets need to be sold above NAV and they need board approval. Elsewhere in the announcement, the board planned to treble the current size of the share buyback program from 50 million to 150 million. Now, this should help with the goal of narrowing the discount at present, which is about 35%, as we mentioned. And this is coming from the trust's existing cash pile from previous disposals. They also have plans in place to increase the dividend from this cash pile too, with a current prospective yield of around 10%, which means it could appeal to many income-orientated investors. So moving on from the news, Joe, we welcomed Richard Sennitt, manager of Schroder Oriental Income, as a speaker in our webinar series. What were some of the key takeaways from Richard?
Yes, we had a particularly interesting webinar from Richard about investing in Asia. And one of the key takeaways was that Asia is often overlooked by income-seeking investors. So if we do some benchmarking against traditional income sectors, SOI is currently trading on a dividend yield of 4.3%, and that's comfortably above the 3.6% yield for the MSCI UK Large Cap Index and 3% for the same index in Europe. And also worth saying, it's not just a recent thing either. Income has provided a significant proportion of total returns for Asian equities over the last decade, in fact.
So it's very much a kind of dual income and growth mandate for SOI.
Yes, the trust offers the opportunity to blend an attractive income stream with the growth story in Asia. Just mentioning a couple of stats, GDP growth is forecast to outpace the G7 nations, and SOI is well positioned to take advantage of some of the unique growth drivers across the region. So, for example, around a third of the portfolio is in export-heavy markets such as Taiwan and Korea, a quarter's in more domestic plays in the ASEAN countries, a quarter's in China, where Richard sees some valuation opportunities, and some in Australia also due to its strong track record of shareholder returns.
And what about the prospects of tariffs for the Asian market under Trump 2.0?
Yeah, I think we'd all agree that's certainly a very hot topic at the moment, particularly for the EU. Yeah, while tariffs are clearly a potential headwind for Asia, Richard feels the markets are pricing in a fairly bleak outcome on that front. And actually, ironically, China ended up increasing its share of global exports after the Trump 1.0 tariffs, thanks to growth in exports to other emerging markets. And actually, reshoring and differential tariffs could benefit other Asian markets such as Vietnam, Malaysia and Indonesia.
And we also heard from Masaki Taketsume, manager of Schroder Japan, sticking with that kind of Asian theme, Joe. What did Masaki have to say?
Yeah, there's been quite a lot of chat in the financial press about Japan, not least as Warren Buffett recently announced he's increasing his stakes in 5 Japanese trading houses. Masaki spoke about the narrative centering around politics and actually equity markets being fairly agnostic to the controlling party in Japan. The long-term play on corporate governance reforms and productivity improvement being the key to the long-awaited inflation story.
Yeah, on that note, Joe, what were Masaki's thoughts on the return of inflation in Japan?
Yeah, it's fair to say that Japan has had the opposite problem to the one we've had in the UK and the US. And Masaki spoke about Japanese companies regaining pricing power for the first time in decades, thanks to inflation and real wage growth. And he felt this should drive a virtuous economic cycle, so price rises driving earnings growth and driving further wage increases. So definitely a positive, particularly if it goes hand in hand with those productivity improvements.
And you mentioned briefly about the kind of corporate governance reforms. What did Masaki say about that?
Yeah, this continues to be a powerful driver of returns for Japanese equities. Masaki spoke about the healthy rise in dividends and share buybacks on the topics, but also 50% of companies are still trading at a price-to-book ratio of less than 1, particularly in the small cap end of the spectrum. So plenty still to go at in terms of improving capital efficiency. And one last point being that Masaki's value focus has led to the trust comfortably outperforming the topics over 1, 5 and 10 years in both share price and NAV terms. So a strong track record for Schroder Japan.
Now, unfortunately, we don't have time to cover all of the webinars that we heard from in this month's roundup. But if you would like to hear from the managers of Scottish American, Pacific Assets, Aberdeen Asian Income, Ashoka India Equity and Edinburgh Worldwide, you can, of course, find all the recordings on the KTI website under our events tab.
And Ryan, what do we have on the results front for this month?
Yep, just a couple of results to cover this month. We don't fall in a sort of natural course as we haven't had a huge amount. The one that we did have that is quite well held and often appears on the podcast was Greencoat UK Wind. Now, they had a bit of a tough year. They faced a few headwinds, no pun intended, and had NAV total return down about 8.5% for the year. However, there were some positives. The dividend cover remains fairly resilient at 1.3 times, and the trust was able to increase its dividend payout at a rate above inflation. So there's still plenty of positives there. Now, the reasons behind the sort of challenging period were power prices and wind speeds. All of these factor into the long-term valuation of UK wind, also sort of falling inflation and things like that have also impacted it. The managers are doing a lot to try and encourage the share price to recover. So currently trading at quite a wide discount. There is quite a large share buyback program that has been initiated. This has been going on for a number of years and tried to support the share price, but they have announced further applications on that too.
And we also heard from one of the BlackRock trusts as well in terms of results.
Yes, that's right. We also had results from BlackRock Throgmorton. They had their full year results for ending 30th of November 2024. Now, the trust actually delivered another year of outperformance, outperformed the benchmark by about 2.2% over that period. And now this marks 9 out of 10 years of outperformance. However, manager Dan Whitestone was actually a little disappointed with that, which we think is a sort of sign of his very high standards. And that is really because of how the year was split. Pretty much all of this outperformance came in the first half of the year. The trust outperformed by about 2.4 percentage points. And that was broadly flat for the second half of the year. So the market was down about 2.5%. Trust was down sort of approximately the same. Now, this outperformance in the first half of the year came primarily from stock selections. So good stock picks in the likes of Gamma Communications helped, as did Materials Group Breeden, which he thinks is a good example of their stock selection because of their management ability. So this is Breeden's management ability to take out some costs and take market share despite a sort of shrinking revenue pool broadly in the market. However, second half of the year saw some real headwinds. I'm sure everybody's aware of what happened in the UK in the second half of 2024. Sentiment really turned negative, and that brought down markets broadly. It's something Throgmorton wasn't able to escape for. The board used significant share buybacks in the year to try and narrow the discount. They bought back nearly 10% of the opening share count in the financial year and have continued this apace since. So a further 6.5%, closing in on 7% bought back of the shares. So really trying to support that discount. The trust itself is primarily capital growth focused, though it does pay a dividend. This had a big jump in the year of 22%, meaning that the trust offers a yield of around 3% at present. One of the changes in positioning we saw was that the manager, Dan, tried to bring down some of the exposure. Now, Throgmorton's quite sort of unique in that it uses both long and short positions to increase the exposure. That means that not only can they benefit from holding stocks if they go up, but also they can short stocks if they fall. So while peers might be able to just avoid them and not buy them, Dan can actually make money from those falling. They have decided to bring down some of this exposure in the trust to try and reduce the overall sort of market exposure, just in light of some of the potential headwinds we've got coming up. So now moving on to podcasts, we welcome Richard Staveley, manager of the Rockwood Strategic, as our guest on trust issues. Can you give us a bit of a flavour on some of the topics you discussed?
Yeah, as always, Richard was a very entertaining guest, and you can listen to this podcast as well as our other podcasts on YouTube, Spotify and Apple Podcasts. The overriding theme in this podcast was that there's plenty of hidden gems in the UK small cap sector if you know where to look, and that's where active management can pay dividends. For any listeners that aren't familiar with Rockwood, Richard runs a concentrated portfolio of around 20 companies at the smaller sub 250 million market cap end of the spectrum, and he's looking for stocks that can at least double in value over 3 to 5 years.
And Rockwood is a really interesting investment trust, and it's managed to deliver some impressive returns despite the very challenging backdrop that we've seen for UK equities.
Yes, as we know, it's been a fairly torrid time for UK equities given the macro pessimism and also the reversal in business and consumer confidence. We'll skirt politics for now, although Richard had plenty of thoughts on that topic too if you want to listen to the podcast. But Richard's focus on self-help means that his portfolio has performed very well despite the challenging backdrop, with Filtronic having delivered a share price increase of 250% in 2024, 230% for Funding Circle. And when you bear in mind that number was 170% for Nvidia, that's a pretty impressive set of numbers.
And has M&A been a key theme in the portfolio?
It has. Richard expects a significant proportion of exits will be from M&A, with trade and private equity buyers snapping up UK PLCs at depressed valuations. And the control premiums have been a tailwind for Rockwood's returns. Richard repurchased a stake in regional media group National World in early 2024 when it was rather unloved. It was trading at a P ratio of 4 times. A trade buyer came in at the end of 2024 at a 50% plus premium, and that meant that Rockwood almost doubled its money in less than a year. So a very lucrative investment there, all in all.
And now moving back to Japan, David, you said you spoke to Megumi Takayama from Chikara Investments. What did she have to say?
Yeah, no, we've already touched on a lot of the points that Megumi made because, you know, a lot of the drivers of Japanese equities are pretty well known. Obviously, Masaki would have spoken a lot about them. One thing she did want to point out on the corporate governance side of things was the unwinding of cross-shareholdings, which we've seen. This is the practice essentially of Japanese companies owning shares in each other. Now, I think this is maybe slightly kind of difficult side of the corporate governance reforms to get your head around. So yeah, basically, you know, Japanese companies will kind of own shares in each other. And, you know, I think it's kind of seen broadly as kind of protecting Japanese companies from hostile takeovers. You know, so you've got a kind of a good kind of loyal shareholder there to block anything. Now, by selling these shares that they own, Japanese companies can kind of free up more cash to kind of use to finance their future growth, to pay dividends, or to buy back shares, which would clearly be another positive for shareholders. So all this kind of corporate governance stuff is quite linked. And going back to tariffs, obviously we've kind of mentioned about that. Now, Japan is kind of geared to the global economy, so it's expected to be impactful for Japan. However, Megumi did make the point that Japanese car makers in particular have been investing in the US for decades. So this could leave them in quite a good position when it comes to dealing with Trump. Now, changing topics slightly, Joe, which trusts have investors been adding to their buy lists?
Yes, global strategies once again remain the name of the game here, but JP Morgan Global Growth and Income, known as JGGI, knocked Scottish Mortgage into second place. As we've mentioned on previous podcasts, JGGI offers a best of both worlds income and growth mandate, and unlike most of its peers, has managed to match the stellar returns of the S&P 500 with a 5-year return of almost 130%. F&C and Alliance Witan also made the top 5 and showcase the merits of a multi-manager approach, with 10-year returns exceeding 200%, and Greencoat UK Wind continued to curry favour in the sustainable infrastructure space with a 9% dividend yield.
And Joe and David, I know you've had the joys of writing a regular column on your personal investments over the past few months. You went head-to-head with your winners and also rounds over the last 6 months. Can you tell us through the results of that, please?
Yeah, I'll admit I have been somewhat trying to garner a bit of an unfair advantage by furtively tapping up our analyst team for tips. But you've become suspiciously resistant to my efforts, so I may have been double-crossed, I fear, on that front. However, back to the numbers. Games Workshop topped my table with a 45% return over the last 6 months, followed by just under 30% for Barclays and Scottish Mortgage, so great news for UK equity holders. If you're a slightly nerdy Warhammer type fan, which I am not, however, you will be familiar with Games Workshop. It sells miniature figurines and the like, and it's had a really good run on the back of a deal with Amazon. It was promoted to the FTSE 100 a couple of months ago as well on our Market Matters podcast in December. So over to David now for the glory.
Yeah, actually, I mean, I think it's interesting, isn't it? I think 2 of our top 3 performers were the same. So I also own Games Workshop and Scottish Mortgage. I suppose, they're quite popular kind of with private investors. My other one, happily, was Raspberry Pi, which was my kind of best performing stock, which I actually don't have the numbers to hand, which is a bit of a pain.
It was fairly impressive though, wasn't it?
Over 120% or something. Although I should point out that in a very kind of quick period of time, it's now down about 25% from its recent high. So maybe less impressive once we kind of pick it up. Last time, do we want to go into our worst performers, or are we gonna?
No, I think we'll skip
wait?
those. You can read the article if you want to find out our worst performers.
We won't hang our heads in shame quite yet on the podcast.
But I still think we need to see some scores on the doors. So who won overall?
David had more of a roller coaster. Is that fair to say, David?
Yes. I mean, saying that Raspberry Pi doubled, my worst performer halved. So I think there's some kind of symmetry in that, isn't there?
Yeah, I think I edged it just with a 7% gain over the last 6 months, although in fairness, both of us had periods with large chunks of uninvested cash, so I think all to play for in round 2. Would you agree, David?
Yeah, I think so.
Okay, well, we look forward to hearing the results next time round. Now, David, you've been speaking to trust buyers and wealth managers galore for your asset allocation feature. Where are they finding the best value at the moment?
Yeah, I always find this article, which we kind of do on a quarterly basis, really interesting, just to get a sense of where the pros are kind of looking to invest. And, I can tell you that unsurprisingly, pretty much all of our asset allocation are investing more into the US, even the most valuation sensitive of our panel, which I think is quite an interesting thing. Clearly, they're much more kind of looking for value strategies, rather than, tapping into the Magnificent Seven and their kind of higher valuations at the moment. And they are kind of warning, I think they're all kind of warning on that risk of kind of being passive market cap weighted in your US allocation. We've seen, the last few days, the kind of tremors. I mean, Nvidia's extremely kind of volatile at the moment. So they kind of prefer, small caps, financials, value stocks. This is all about this kind of market broadening. And it was quite an interesting snippet that Philip Chandler, one of our panelists from Schroder Investment Solutions, pointed out that Apple, Nvidia, Microsoft, Amazon, Tesla, Meta, Microsoft, Broadcom, and TSMC, so 9 stocks, have the same weighting in the MSCI All Country World Index as all the stocks in that index in Japan, the UK, Canada, China, Switzerland, France, India, Germany, and Australia put together.
Yeah, that's quite a mind-blowing stat. So where else are they looking beyond the US?
Yeah, so we've touched on Japan a few times already, but it's certainly an area that they kind of think remains relatively attractively valued. And we've talked about the corporate governance things. They certainly see this kind of as a theme, and a few of those are kind of playing the story through the kind of active investment trusts in the Japanese smaller companies sector. And another area we've kind of touched on is alternatives. So Hawksmoor, one of our analysts, our panelists, have topped up their positions in some of the more core infrastructure and renewable names, while Peter Walls at Unicorn has subscribed to the Achilles IPO, which I think he kind of sees as being complementary to another one of his long-term core holdings, which is TR Property, which is kind of similar. It kind of takes that not necessarily activist approach, but invests in property, REITs and kind of property investment companies itself.
And that is it for this month's roundup of investment trust news. If you'd like to find out any more on any of the topics that we've covered today, head over to the Kepler Trust Intelligence website, and we hope you join us again soon.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.